So, good morning and welcome to our digital business breakfast. My name is Maciej Meder. I'm a managing director at ZTB Poland, and I have a pleasure to moderate today's meeting. Today, we would like to present our update of the annual European Banking Study, which this time is dedicated to a specific topic of ESG, namely how banks are progressing on their path to net zero emission. So how to measure CO2 emissions and what banks still have to do in this area. I'm very glad to welcome today my two colleagues, experts in this topic and co-authors of the study, Dr. Eckhard Bauer and Dr. Frank Muzek. Hello.
Good morning.
Please note that the meeting is recorded. We will publish this shortly in a few days on our webpage. So if you miss any parts of today's meeting, you can watch them, of course, also later. Feel free also to share it with other colleagues who did not manage to join our webinar today. As always in our meetings, feel free also to comment or ask questions using the chat function or raise your hand functions. The microphones are muted. But if you would like to contribute, just give me a note and we will be observing the chat. We will also distribute the material which we are presenting today also after the meeting. So everything which you will see today will be also sent to you in a couple of hours after the meeting. Okay, good. Colleagues, let's start. I think it's a good idea to start, first of all, with a short introduction what banks are actually covered by our European Banking Study and this specific topic which we are analyzing today, so the CO2 emissions. So Eckhard, if you could just tell us a bit about the sample which we have and what is the scope of our study, please.
Yes. Sure. Let's start with a short look at our sample. We are focusing on the 50 largest European banks by total assets. It's a really heterogeneous group. It starts with BNP from France, with the largest European bank, and it goes down to PostFinance from Switzerland. We see that this group has around 20 universal banks, so which are doing corporate business, retail business, investment banking, and so on. A lot of them coming from Western European countries, so France, UK, Germany, Switzerland, and so on. You know all these names, of course. Then we have a really large group of retail-focused banks, especially from the southern European part, so from Italy and Spain. There are a lot of retail banks, and we also have some wholesale banks that are really focusing on corporate business. And we use this different business model clusters in our whole analysis, and the whole analysis you will see in the next 60 minutes or 55 minutes is based on this group of the 50 largest European banks and this different business clusters, so universal banks, retail banks, wholesale banks, and we also decided to put in a regional split, so Western European banks, South European banks, and the Nordics. So that's some kind of the first sample we see in the last few months or in the last year. We saw some changes here, so we saw some mergers. Intesa, of course, merged with UBI Banca in Italy. There was also a takeover in France, and maybe just to mention this, in Italy, there was a merger of a lot of local entities, cooperative entities into one banking group, making new entries here. That's the ICREA banking group. So that's some kind of the basis for the whole study and for the analysis that are coming on the next slides.
Mm-hmm. Okay, the topic of the study, or let's say the focus topic, because we are updating the study a couple of times during the years, are now CO2 emissions and reduction targets. So maybe let us have a short look on the bank's obligations in terms of CO2 emissions and how far these top 50 banks already are on this path. But maybe before we go on with the presentation, I would like to have a kind request to our participants of today's webinar to fill in a short survey, which we will publish shortly in the comments. So if you could share your opinion, your self-assessments regarding CO2 targets and measurements, please do it. And in the meantime, Eckhard, if you could please shed some light on the bank's path to net zero, so how these top 50 banks are progressing. And now I'm publishing also the link in the chat function. So if you could just click on that and fill in and answer 2 simple questions, feel free to do so. And we will also present the results in a couple of minutes. Eckhard, please.
Yeah, I think it's important that the green transition is really a huge challenge, and not for other whatever next 2 or 3 years. It's for the upcoming centuries. And from my perspective, it's very important that the role of the banks within this green transition is really essential. So banks will have a key role in this transition, and they will also see some new roles. So coming from all the stakeholders, so the regulators, the investors, the clients, of course, and the governments, they all expect from banks to be not only the lenders of this green transition, but also that banks decide what is green, what is brown, and so on, and to be an ally here, or to be in control of this green transition. And that's really a huge part. And from our perspective, therefore, it's very important that banks should also go towards net zero. And when we talk about net zero here in this study, in this context, we always talk about net zero of the portfolio emissions. So the own banking emissions, of course, that are not really relevant because they are not very high. The huge part for banks is are the portfolio emissions of the emissions of the portfolio. That's really a huge part. And in the first part, we want to focus on where are the banks on this path towards net zero? Where are they currently standing? What they are really doing? And what we can see here is that from this largest 50 European banks, a lot of them really have committed towards the goals of the Paris Climate Agreement. They also say, okay, we report some own emissions, so our own emissions, from our operative business and so on. And there are also some general targets in terms of, okay, we have to look at the greenhouse gas emissions and so on. The key point is that this really goes down when we go ahead in this on this road. So this means that a lot of banks do not have really concrete targets how to reach net zero. So they have said, okay, we want to do something here, but concrete targets, what, when, and so on, that's really missing at some banks. You can see this here in this pie charts here, and then also to report own emissions. So this portfolio emissions, this is also not very common. Just a few banks really report emissions of their complete portfolio, and some are really just reporting the emissions of parts of their portfolio. A lot of banks do not report this greenhouse gas emissions, so they are not really open here, and that's from our perspective the key point. So a lot of general commitments, a lot of general targets, but if we want to make it really concrete, then there are a lot of things missing. That's from our perspective the main part here.
And have you identified, Eckhard, some banks in the sample which we analyze, so among these top 50 as more or less advanced in terms of CO2 reduction disclosures and reduction targets? Do you see any patterns in which types of banks or any regional differences?
Yeah, we clustered these top 50 banks into 3 groups. We say that there are some banks that are still in a starting position, let's say this way. So they have these commitments. They report also their own greenhouse gas emissions, but they are not really having some general targets, concrete targets, and so on. Then there is one part or another group that is moving, so they are ahead of this starting banks. They have this channel targets, and some banks also have some concrete targets, but really they are not reporting these greenhouse gas emissions. And then there is a group. We say it's around 13 banks of this top 50 banks that are ahead in terms of they have this concrete targets, and they also at least partly report their portfolio emissions or are part of the PCAF disclosure agreement. And if we look at the lower part of this chart, you can see that yes, there are some patterns. We see that especially these large Western European retail banks, that they are more ahead. And there are other banks, especially from the southern part of Europe, they are more in a starting position, or more, at least moving, some kind of moving. And what we also can see is that the wholesale banks, that they are almost completely in the starting position. And the key part here is that we see also a pattern in terms of banks that are listed, stock market listed, and banks that are not stock market listed. And we see that banks that have this additional pressure from the capital markets, they are more ahead. They are in front here compared to the non-listed banks, and that's the part. So the non-listed banks are more in the starting cluster here. And especially the large Western European universal banks. So all this really big banks you saw on the first chart, they are more ahead, because from our perspective, that's at least our interpretation, that they feel the pressure from the capital markets, from the investors, to go ahead here and to follow this path towards net zero ahead of the other banks.
Okay, maybe I can share. I mean, we have at the moment 11 responses, so maybe let's just have a look on the results. Just let me share for a second my screen, and what are the responses. So the great majority, I mean, we ask actually 2 questions. I mean, first question regarding specific targets regarding reduction of CO2 emissions in the loan portfolio. And we asked, okay, are these targets? Yes, we have reduction targets before 2040. And here we have almost 70% of participants who submitted this answer. No specific plans, roughly 1/4. And also here 8% regarding targets, but after 2040. And the second topic, which we are slowly forwarding to, is: do you calculate? Does your institution calculate CO2 emissions for your loan portfolio? And here, great majority answered no, not yet, or only for a small fraction of the portfolio. We have roughly 17% of participants who answered yes already for the complete portfolio, and for the parts also to responses. I would encourage also, because we have so far only 12 answers and over 60 participants, so I would encourage all to participate in the survey. We'll check if these proportions are the same in the next minutes when we are discussing that. Now I would maybe pass the word to Frank, and maybe we can dig deeper into the CO2 emission topic, because I would say this exercise does not seem to be an easy one. What approach was actually taken in our study, Frank, if you could elaborate on the methodology which you used to calculate these CO2 KPIs?
Yes, sure. And maybe Eckhard, you can share the slides again. And I have to excuse myself already because now we have to get a bit more into the technicalities and then just ask questions if I would be too fast, but I will try to explain it so that everybody can understand. What we have been using as the basis for our methodology is the so-called PCAF logic, something Eckhard mentioned in the beginning, that several banks are looking into it or having committed to using it in the future, or some are using it already, and very few have published results based on either this logic or something very similar to it. What it stands for is Partnership for Carbon Accounting Financials, and the basic idea is that with all the financing and funding a bank provides to their clients, the client is using that money for whatever reason, and the way how this money is spent by the client, to put it like this, is producing emissions. So that is the basic logic, and that means the bank sort of inherits this emission into its portfolio. So for all the money provided by a bank to their clients and the emissions related to that, those are either called portfolio emissions or financed emissions. And then that is the biggest part of emissions which are attributed to banks. And that's why this topic is so important. And this is also the biggest block for, I would say, any bank, which they need to bring down to a net zero number until latest 2050, and some have targets even before, some have, and we heard that before, have quite challenging targets. I mean, some want to be on this net zero, maybe already 2030 or 2035. So, and we will show you where the banking market is standing today in a couple of minutes, but just have a look at the methodology. So what we're trying to do here is that we need to link the financing a bank provides to the emissions which this produces. What we have been using is numbers from the EBA transparency exercise. And that's a very nice data source, to be honest, because it gives you, for all the banks in our sample, a split of exposures those banks have in industry sectors on the one hand, and in countries on the other hand. And these are two very important factors. We will come to that later again, but these are very important factors to determining these emissions. So this is sort of the financing amount. What one then needs to do is to differentiate between the sort of usage or purpose of the money. And what we did here is we differentiated between money which was loaned to corporates, and that's the upper part, and money which was used to finance real estate, and that's the lower part of that slide here. So let's have a look how we calculated this for the corporate loan exposure. The basic idea of PCAF is that the whole capital a company owns or has or uses, which is basically the balance sheet, more or less, is invested. These investments are used to produce products, services, what have you, and you have emissions being the result of these investments. So what we're trying to get at is something we call an emission intensity, which is just the amount of emissions related to the invested capital right? So in the sense, how many emissions does a corporate client produce with €1 or dollar or what have you investment? And then, I mean, since we do not really know what or how the banks or what the money the banks provide is actually used, we needed to go with some assumptions. So PCAF in general is looking at in the nitty-gritty detail, meaning at really any single deal. So if you would want to make this perfectly, you really need to go to the whole portfolio, to the whole business, and try to find the purpose of the financing a bank provides. Because it makes a difference if you're financing solar panels, for example, compared to, I don't know, a coal plant or something like that, just to make some very extreme examples. Since we are only using publicly available data and we don't have data on that level, we had to work with average numbers here. So what we did is we were collecting the statistics on greenhouse gas emissions per country in our sample, or more or less per countries for which the banks are operating in, and also for the industry types the banks are having exposure with. And then we combined this number, we combined this with the total equity and debt which corporates have in these country and sectors and so on. And this gives us the emission intensity. And then we multiplied this with the exposure a bank has in this combination of industry sector and country. And then you can aggregate this across all these combinations and you end up at the total amount of greenhouse gas emissions for each and every bank. And if you do this for real estate, the logic is pretty similar. The only difference here is that we know the purpose of the money. So it is used to finance a certain real estate. So what one should do here is to dig out the property value of this real estate. For us, that meant we had to go with an average property value in a certain country and in a certain class. And then you find data from certain data providers like OECD or ECB, European Union, European Commission, whatever. So there are a lot of sources you can look into, which give you those aggregate numbers again for the general or the average emissions per energy efficiency levels of certain properties. And you also find differences between properties which are used by corporates or which are more used by private individuals and so on and so forth. So this again, this average aggregated greenhouse gas emissions divided by the property value gives us again this emission intensity for €1 applied to finance a real estate object. And then we had to multiply this again with the exposure banks an individual bank has in that market, in that area, in that energy efficiency class, which gives us then the financed emissions used for mortgages. And putting those two big things together gives us the overall emission of the portfolio.
Okay.
I hope everybody could follow. If not, now would be the time to ask.
Sounds like a comprehensive and a complex procedure, which required crunching a lot of data. If there are, I would say, some comments later, just please drop them in the chat function, and we will come back to them in a couple of minutes. Now, I would say we presented the methodology. Maybe let's look shortly on the results. So basically, when you already inserted the data and calculated for banks, what are the biggest banks with, I would say, highest absolute emission levels, and maybe also in relation to to total assets. I would say maybe also regarding, let's say, call it CO2 density. How does this comparison look like? If you could please provide some insights on that.
Yeah, sure. I mean, what you can see here is the absolute amounts, the results of our calculations aggregated across those banks in a certain sample or group. And what you can also see, and we will have a bit more detailed look later on to that as well, but what you can see is that there are several drivers which should be kept in mind here. One is definitely the overall portfolio size, right? I mean, that is just sort of the amount of money you are lending is driving the portfolio emissions. I think that's actually quite a simple fact. But it definitely makes a difference for which sectors this money, or in which sectors this money is invested. I think that's also something one can easily follow. So if you as a bank have lent money to sectors which are deemed as very carbon intense, so to speak, and we just have some examples here on the slide, that is agriculture, mining, manufacturing, electricity, gas, transportation, then by default, you have higher numbers in your portfolio, at least following our approach, since we don't really know for which purposes this money was used, right? So having this more ballpark figures here, that would be the average emissions for this sector is driving the emissions you as a bank inherit in your portfolio. But what you could also see, and I think that is quite interesting, another factor is the country perspective. And what this slide shows is that we have more or less a difference if you go across Europe from north to south, right? So if we just look at the very right here, so the Nordic universal banks and the Nordic retail banks, they show quite low emissions in their portfolio compared to the rest of Europe, even if they have more or less comparable sizes in the sense of exposure at default. So just to make a comparison here. So for the Nordic retail banks, the overall exposure this banking group has is 950 something billion of euro, if I'm not mixing that up, which is actually slightly higher than what our 6 Western European wholesale banks have. But the absolute emissions of that group of the Western European wholesale banks is by far larger as for the Nordic retail banks and also for the Nordic universal banks and so on, right? So this is what I meant before, that also the country banks are operating in makes a difference. And one key factor here is the energy mix used in these specific countries. So we have countries in Europe, and the Nordics are among those, which have quite a high share of sort of green energy, right? Wind, water, solar, and so on and so forth. And this is really helping them because this energy doesn't really produce emissions. The same goes for nuclear power, actually. But if we look at, say, Germany, Poland, Russia, other Eastern European countries, here we have still quite a large share of, for example, coal, which is being used to produce the energy. And this gives you a lot of emissions. And this is what's happening for those banks here as well. So it's not just the portfolio size, it's not just the industry a bank operates in, it is also the countries where your clients are having their sort of production sites or where the money is actually used. And that's something which becomes very obvious when running these analysis, and that is something, at least we believe, which is potentially a new information for banks, or which is not yet at that level understood and data-wise available at banks. So this is definitely something all banks need to look into and really come up with this understanding of the combination of industry sector, client segment, if you will, but also the country you are operating in, because these are really the driving factors for the emissions here.
The difference, for instance, in this electricity gas sections, were basically depending on the country which the portfolio is invested into, right? I mean, because we have not analyzed it on the single name level, but I would say on the country slash industry perspective. So in this respect, basically on the average in this particular country, this industry electricity was less or more carbon intensive, right?
Exactly. And I think we have a question on the methodology.
Yeah, so I think we have it, but we don't fully have it. So just maybe let's wait for the question, and let's come back to that in a second. So if you could only drop your question here. Okay, here we have a question. So let's go directly deep into that, Frank. So if we have only financing, also other products here like treasury.
So what our basis of data are the numbers from the European transparency exercise. So whatever is called exposure in the transparency exercise data set, this is the numbers we were using. And that for sure has or is financing or lending products, but it's also to some extent security business. So all the exposure on the asset side, which is in the European transparency exercise. If you would sort of translate that, or if you would like to do something similar, then what in our point of view one should do is really look at the whole asset side of your balance sheet and try to understand what this money is invested in, and then try to find the related emissions these investments are producing.
We have also next question regarding working capital loans for companies, how they are treated in the PCAF methodology.
Yeah, and that's a tricky thing, right? So as mentioned before, PCAF is applying a bottom-up approach, meaning you would need to look at each and every single deal you have, and you would also need to understand what that money is used for. If we have a working capital loan that is, in that sense, I mean, purposeless might be a bit an unfair word, but we don't really know what it's used for, right? This is what I'm trying to get at. So what you can do here is that you work with then industry, sector, country averages just to capture what's happening here. If you know what the money is used for, right? If you know, okay, this goes into building a new plant or a new structure, or this is used for buying a machine, or this is used for an electric car, and so on and so forth, then it's easier. But in some cases, you have this where you miss the purpose, then you need to come up with averages. On the other hand, and we might come to that also later on, our proposal is go through your portfolio and look at the biggest blocks first, right? And if that is mortgage business, then start with that. So just that you start with these pieces where you have the biggest impact and where you sort of also have the biggest numbers in the end. So what is really driving your portfolio emissions in the end, and then go from there to the next one, and so on and so forth.
Okay, Frank, let's maybe come back to the results. I think also we wanted to share a bit some insights regarding this intensity. I think we have a detailed slide on that. Yeah, exactly. I would say how these comparisons look like in particular countries, how this emissions to assets ratio look like, or to exposure look in the particular country.
Yeah, I mean, I sort of touched on it already a bit before, but this chart here shows it quite nicely, at least in my view. So what we see here is exactly this financed emissions, or the emission intensity of the money the banks are providing to their clients. So what you see here is how much average emissions these different bank types inherit into their portfolio by 1 million euro they lend to their clients. And this is, again, is an average across the whole portfolio of each bank type. And what becomes really apparent, and we touched upon that before, is the Western European wholesale banks, since the largest part of their portfolio is dedicated to corporate business, corporate clients. And in general, the emissions from corporate clients are larger than the emissions from private individuals and other client groups. This is what's driving the emission intensity of the Western European banks. And what we have here as well is that, at least for some of the banks in the sample, they as well have a high share in sectors which are very carbon intense, so to speak. So that is also driving this bar up here. What you can definitely see as well is that it makes a difference if you are rather financing corporate clients or rather financing retail clients, right? So the bars for the retail banks in the sample are always smaller, lower than the ones for the more or less universal banks or wholesale banks, because it's just what I explained before. So the driver here is the corporate portfolio. And then, and we touched upon this as well, we have this country or regional view here, right? So let's go back, sorry, just to the other slide. So once again, the Nordic banks have lower emission intensities regardless of the business model than, for example, the Southern European or the Western European banks, right? And this is what I mentioned before. So the key driver here is, again, the energy mix. So this brings together all these perspectives. And for an individual bank, and this is what we try to do with the matrix on the next slide, is for an individual bank, it is very important to understand what is your driver here. Is it rather the country, which is the y-axis here? So we have a couple of banks. It's probably hard to read, but there are some of these gray dots more to the upper part of this chart. So for those banks, the main driver is the country perspective, not so much the industries they are invested in. And then we have several banks, and this is the x-axis here, where it's more the industry which drives the overall portfolio emissions. For the majority of banks, it is a combination of both, but we have some, and again, it's quite hard to read, but on the very, very right to this chart here, there is one bank which has a very high average emission intensity coming from the industry instead of from the country. But once again, what I'm just trying to tell here is you need to go into this level. You really need to understand what is driving your portfolio emissions to the next step, be able to work out strategies how to bring this down over the next years.
Okay, so I think it's a very nice exercise just to show, I would say, how big this differences between different banks can be. And I think this exercise has to be conducted on the individual basis. based on all these calculations and the study which you conducted, I would say, what are the conclusions? If you could just summarize shortly the results and the implications for banks.
So what we learned is, and we were not sure ourselves when we started the exercise, to be honest, but what we learned is it is possible. It is possible to come up with results one can more or less trust by applying such a top-down analysis. We also think that if a bank is not publishing this data on their own, there will be, for example, analysts and other groups who will do something similar than we did here. So those numbers will get out in the world, is just what I'm saying. And the less information one has about an individual bank, the more you have to revert back to assumptions, proxies, averages, what have you, which could mean that if a bank is not publishing these figures, then what we have calculated here, or what analysts might do in the future, would probably show actually a higher number than what the bank is calculating or having as results on their own. So what I'm saying is basically, if you have those numbers, if you are sort of okay with the methodology, if you as a bank feel good to go out with that, do that, because otherwise somebody will work with averages which might result in higher numbers than you actually have, since those averages, they cannot take into account the actual purposes the money is used for. And this is then a second finding we have. So these numbers here are quite volatile, right? So if you just change a little bit the share in a certain industry, or if you move from, say, a little bit of exposure from a Nordic country to Germany or to Poland, that brings a huge increase in the emissions already. So that is something just to be kept in mind, that these are really important and volatile drivers here. But on the other hand, what this study also reveals, at least in our point of view, it will be a very, very hard exercise to do this for the whole portfolio on a single deal level. So this methodology we developed here can be applied in two ways. It can give you quite quickly a ballpark figure, and it might show you where to look for, where to go more into details, because just you have sort of a big block sitting in your portfolio. But the averages and proxies we were using, or we now have available, they can also be used for those parts of the portfolio of a bank where it just doesn't make sense to go so much into detail, because it would be too costly, take too much time, too much effort, and so on and so forth. And our recommendation, and then I'm jumping a bit, but our recommendation is really to apply an 80-20 approach, right? So focus on your biggest blocks in your portfolio first, go into details there, and work with assumptions, proxies, averages for the rest. And then you can learn with the methodology, and then you can go more into details. And then also the world is evolving, right? I mean, there will be more coming. There will be more data coming. There will hopefully be coming some sort of standards, and then PCAF is one. We know that the accounting bodies are working on something. It might be that the regulator will come up with something. So over the next years, we definitely see that standards need to be developed, which then are applied. So start now and then just detail it out later on.
Frank, we have one question here regarding the data which you used for average sector emissions and the country. So what was the source of this data, if you could just indicate?
Yes, and Eki, just help me out if I'm forgetting something. But one key source we were using is the OECD, which has quite nice numbers differentiated by countries and industries. They also give you numbers on this total capital or total balance sheet of industry sectors. That was quite helpful. Then I think we were using ECB data. We were using data from German Statistics Office or European Statistics Office and stuff like that. So there is data from the UN and some climate initiatives. So a lot of is out there, but one really needs to check what is relevant given the regions, countries you as a bank operate in.
Yeah, I think if you want to have some good sources, it depends a little bit if you are focusing on one country or just two countries, then the respective national statistical authorities are the best source from my perspective, because then you can really have some regional splits. If you are more present in the north or the south of this country, then you can use some regional data. If you want to do this on a global basis, as we've did, or on a European basis, then all these channel sources like OECD are really the best ones.
Okay, good. Thanks a lot for answering this question. Maybe just let's come back shortly also to the conclusions. I mean, this we summarized, but basically, I think the good question is how the banks should move forward now. Yeah, so because I think this exercise shows that it's already certain complexity in the calculations. I think the data sources are also relatively new. Let's say new to the banks, put it that way. I mean, these are not the standard sources which banks are using so far for instance, some analysis for different purposes. I think we just recently EBA published already the stress testing guidelines. So I think more and more, I think we are moving towards the necessity just really to conduct these calculations. I mean, here particular banks, just to conduct these calculations pretty soon. So Frank, if you just could comment based on the calculations, what would be your recommendations here for banks?
I mean, with looking at this particular exercise, so trying to come up with the carbon footprint in the portfolio, which in turn is an input to certain other analysis as well, right? So the carbon footprint can be one KPI for an ESG score. It can be and is one input into actually calculating the green asset ratio in the end. It could also be an input to the stress testing, and it's something which will need to go into the sustainability reporting anyway. But from our point of view, our recommendation is really start to go through your portfolio, really run a calculation on your own portfolio to get a first understanding of the emissions. And I mentioned that before. Our recommendation is start sort of ballpark, easy, something like we did here, identify the biggest blocks, go into details for those biggest blocks, try to find more detailed data, have a better understanding, refine the methodology there, and so on and so forth, right? So what you need for that, and then this is also what we are supporting our clients with, and where we have a lot of discussions about, what you need for that is really an understanding, and we touched upon this as well, data, right? Data is a huge topic for all the ESG related exercises. So in the end, you need to define for yourself what data you need for that, right? So what are all the purposes you have? you need to define your data, you need to define your data model, you need to link the data you have. Some data you have already in-house, some data you can get from external providers, and others, and that was also one of the questions, or sort of another comment to the last question. It might very well be that the data you actually need for these exercises is not available. So you have to ask your clients. And some of your clients have to disclose it just due to regulation, but especially the smaller clients, they don't have to disclose that. So you need to find ways to sort of source that data from your clients. And that could be when you ask them for their balance sheet, just ask them for their emissions as well, right? So this is then also something one needs to develop in the sense of, let's call it a sourcing strategy. And that might be different depending on the client types. And then for sure, this is related to all we do here. Just develop your general methodologies, how you come up with these results, play with it, and then implement it so that you can do this on an ongoing basis moving forward. Once you have those first numbers, or you have a sort of trustable result, then at least to us, that means check with your general vision and mission you have in going to net zero, because now you have the numbers, right? Now you have a starting point, so you can now come up with ideas how to bring that down. So what do you want to do first, over which period of time? And once you have set that, you just need to monitor on an ongoing basis. If you reach your target, if you need to adjust it, you probably need to develop and look into different mitigation approaches and so on and so forth, right? And on that level, we are also talking with our clients. And then this in the end then touches upon the overall ESG framework, right? So what is your general ambition level? What does that mean for your business strategy? Because one mitigation action could be you don't lend money to certain clients any longer. But if you do so, this would in many cases result in declining revenues, right? I mean, you usually have revenues connected to your business. So that's also something to be kept in mind. If you would try to condense this into sort of one figure, what you need in the future, in addition to a risk return, is also a return emissions understanding, right? So that you can then really come up with strategic decisions here, how you want to go about your business in the future. And it might be more profitable actually to help your clients becoming more sustainable, help your clients work together to bring the emissions of your clients down, because this in turn is also bringing down your portfolio emissions. So this can open up for new business opportunities as well. And once you have these ideas developed, then for sure it's this continuous cycle: reporting, monitoring, reporting, simulating, checking, adjusting, going out, communicating, and then go in depth again. So this is at least what we see as the next steps for the banks here.
Okay, Frank, thanks a lot. We are slowly coming to the end of our webinar. So if there are any questions, just I think we have some time for one or two more questions. But I would also ask Eckhard, just to summarize, I mean, we have already mentioned a lot. I think the first point, which I see here, data, I think we repeated today, I think already several times. But Eckhard, if you just could here elaborate a bit on the key challenges and comment a bit on that.
Yeah, absolutely. So we talked about this data topic a lot today because it's really the essential question. The other challenges from our perspective, so what we really get from our discussions with our clients is that lip service will not work anymore. So there are some expectations from the stakeholders and from the shareholders. Frank already mentioned this before. And so if you really want to stop your investments or you're giving credits into a certain sector, this will do something with the earnings, and you really have to find some new earnings to show your shareholders that you're still earn this money or to really earn this profitability. So that's really a key part. So, and you really have to do something here. It's not that you can really say, yes, we are working on this and so on. You really have to show some results here, and to get this trade-off between CO2 targets and financial performance. That's really the key part here. And of course, we also talked about this. The governance is not settled. So how to bring in the whole topic, not only net zero emissions, but also ESG or sustainable finance or climate change and climate change risk into your bank and into your governance. There are still no best practices how to do this. It reminds me a little bit of how to bring in digitalization into a bank's governance in the past, and you really have to decide what is a good framework for your bank to really address these huge topics, and who is in the lead and who is doing what. And then, of course, the targets and the matrix of your employees, they should be aligned. So if you want to reduce your greenhouse gas emissions in your portfolio, you have to translate this into your targets for your employees or for your steering and so on, and for your steering schemes. That's really the point. So you really have to adjust your bonuses, for example, or your internal target agreements and so on, to be consistent here. And it's really important to do this, because if you just say we want to reduce greenhouse gas emissions and you're not translating this into individual targets, then your employees will still sell credits that they have done in the past, and then you will not be able to reach your overall target of greenhouse gas emission reductions. And of course, these projects, or running these projects, is very challenging. That's what we really hear from the clients and what we can really see at the banks, because the whole topic is really a moving target, and that's a key part. It's a moving target from your stakeholders. It's from a moving target from the regulatory authorities, from the governments, and so on. It's not that the whole topic is really fixed and defined and so on. It's really a moving target, and therefore it's too complex to make a big splash and say, okay, on Monday the first we will do this and then everything is fine. It's really challenging. You really have to be able to have agile modular projects and to really run this, and that's really challenging, a really challenging task.
Okay, I think we are running already to the end of our time, which we have foreseen for today. So Eckhard, Frank, thank you very much for your contributions today and your insightful comments on that topic. I think we will continue this discussion. It's not our first, it's not our last webinar on the topic of ESG. So I also believe that if the participants today would be interested in further discussion, please reach out to us, and we are happy to discuss these topics more in detail. As I mentioned before, we will distribute the material later today to you, and we are looking forward to further discussions. We also left a link with a short questionnaire regarding feedback on the session today, so feel free to share your feedback so we can shape the next events and make them better. Frank Eckerhardt, once again, thank you for your contributions today. I would like to thank all the participants for being today with us. I wish you all a nice day and thank you for participation today. Thank you and bye-bye.